I think risk appetite for growth stocks has taken a hit following the turmoil in the markets this year. Non-profitable companies were the first casualty, and the mega caps shortly corrected after. On the flip side, there was a notable shift in preference towards value, large cap, high dividend stocks in a move that I call back to basics. We're also seeing an increase in demand for deposits following multiple interest rate hikes from central banks. It is now appealing to risk-averse clients. Private debt has also stirred attention. Since the underlying loans are floating rate and short duration, it was relatively shielded from the sell-off in conventional bonds. Diversification, liquidity, and risk management. A well-diversified portfolio across asset classes and sectors is key, as not all instruments are 100% correlated. This year has been particularly challenging because the role that bonds are supposed to play when markets are stressed did not materialize. In fact, it's the interest rate shock which adversely affected financial assets. Once this is absorbed, they will again act as a protection in the portfolio. We also recommend being allocated in sub-asset classes. In credit, for example, inflation-linked bonds and floaters did really well this year. In the equity space, value and large cap have largely outperformed the indices. On liquidity, I would say 85% of the portfolio should be liquid. That is crucial for exiting investments if needed. Sound risk management avoids concentration issues, large drawdowns, and unpleasant surprises. It is incumbent upon each one of us to actively engage in the preservation of our planet. However, we all have our limitations. For the less fortunate, green choices and habits can help make a difference. Nevertheless, wealthy individuals and investors can give back to the environment by allocating a part of their investments to companies that directly or indirectly pursue ESG strategies. The transition to net zero greenhouse emissions by 2050 can only be achieved with the help of private capital. According to estimates from a new McKinsey report, it will require $3.5 trillion a year in capital spending on physical assets for energy and land use systems. This goes to show the role managers and investors must play to achieve these goals.